Financial crises in Europe. Lessons from the past. Europe has long been a global economic powerhouse, but its history is marked by several financial crises that have not only shaped its economy, but also provided valuable lessons for the present and future. From the Great Depression to the 2008 financial crisis, Europe has experienced tumultuous economic events that left deep scars. These crises, while painful at the time, offer insights into the resilience of economies, the risks of financial mismanagement, and the importance of regulatory oversight. In this video, we will explore some of the most significant financial crises in European history and the lessons they impart to contemporary financial systems. The Great Depression, a global wake-up call. The Great Depression, which began in 1929, was one of the most severe economic downturns in modern history. While it started in the United States, its effects were felt deeply across Europe. The stock market crash in New York triggered a global economic chain reaction, with many European countries entering into prolonged recessions. By the early 1930s, unemployment was at historic highs, and industrial output plummeted. Key lessons: the dangers of unregulated markets. The Great Depression highlighted the dangers of speculative investments and unregulated financial markets. In many European countries, including Germany and the UK, stock market speculation and the overextension of credit led to a fragile economic system that collapsed when the markets crashed. The need for government intervention. The Depression taught Europe that when financial markets fail, government intervention is crucial. The European governments responded with varying degrees of public spending and social programs. In the UK, for example, the government created the New Deal-inspired policies that aimed to stabilize the economy and provide jobs. The importance of international cooperation. The Depression also emphasized the interconnectedness of global markets. Protectionist policies, such as tariffs and trade barriers, exacerbated the downturn. This led to a greater understanding of the importance of international economic cooperation, a lesson that would inform the creation of the European Union in the post-World War II period. The 1992 European Exchange Rate Mechanism (ERM) crisis. In 1992, Europe faced another major financial crisis that stemmed from the collapse of the European Exchange Rate Mechanism (ERM). The ERM was designed to reduce exchange rate volatility and pave the way for the single currency, the euro. However, the system began to unravel in 1992, particularly after the British pound came under intense pressure. The UK was forced to withdraw from the ERM, suffering significant losses in foreign currency reserves and enduring a period of economic instability. The currency speculator George Soros famously broke the Bank of England, profiting from the pound's decline, and the crisis prompted the revaluation of exchange rate mechanisms in Europe. Key lessons: the limits of fixed exchange rate systems. The ERM crisis demonstrated that fixed exchange rate systems can be fragile, especially when countries have differing economic conditions. While the ERM was initially successful, the pressures of economic divergence within member states proved unsustainable. The importance of economic convergence. The crisis revealed the importance of aligning the economic policies of participating nations to ensure the stability of a shared currency. This would later influence the Maastricht criteria and the creation of the euro. The lesson was clear: for currency unions to work, there needs to be convergence in fiscal policies, inflation rates, and interest rates. The dangers of speculative attacks. The ERM crisis underscored the vulnerability of currencies to speculative attacks. When investors anticipate the devaluation of a currency, their actions can trigger a rapid collapse. This lesson would be relevant again in the 2008 financial crisis and subsequent Eurozone debt crisis. The 2008 global financial crisis, a European nightmare. The global financial crisis of 2008 was a pivotal event in world economics, and Europe was severely impacted. Triggered by the collapse of Lehman Brothers in the United States, the financial crisis quickly spread across the globe. In Europe, the crisis highlighted systemic vulnerabilities in the banking sector and the precarious nature of sovereign debt. Several European banks were heavily exposed to the subprime mortgage market in the US and were forced to seek government bailouts. The subsequent recession in Europe saw a steep rise in unemployment and a slowdown in economic growth. The crisis also laid bare the weaknesses in the Eurozone. Several countries, including Greece, Portugal, and Ireland, faced sovereign debt crises, requiring international bailouts. The EU and the European Central Bank, ECB, took aggressive steps to stabilize the situation, but the crisis exposed significant flaws in the European financial system and the Eurozone's economic governance. Key lessons: the perils of excessive debt. The 2008 crisis reaffirmed the dangers of excessive debt. Many European countries had over-leveraged themselves, relying on cheap credit to finance public spending and investment. When the global economy contracted, these debts became unsustainable, leading to sovereign debt crises in several countries. The importance of banking regulation. The financial crisis showed that a lack of effective banking regulation can lead to disastrous outcomes. In the wake of the crisis, Europe implemented new regulations to improve financial stability, including the Basel II framework and the creation of the European Banking Union to oversee cross-border banking operations. The need for fiscal discipline. The crisis underscored the importance of fiscal discipline within the Eurozone. Countries with high levels of public debt and deficits found themselves vulnerable when the global economy contracted. The EU introduced measures such as the Fiscal Compact, aiming to enforce budgetary discipline among Eurozone members and prevent a recurrence of the debt crisis. The dangers of financial globalization. While financial globalization opened up new opportunities for European businesses, it also exposed the continent to greater risks. The 2008 crisis highlighted how interconnected financial markets can amplify problems in one part of the world and cause ripple effects globally. This realization led to a greater focus on financial stability and regulatory coordination at the international level. The Eurozone debt crisis, a lingering threat. While the 2008 global financial crisis marked a turning point, its aftermath led to the Eurozone debt crisis, which persisted for years. Greece, in particular, became the focal point of the crisis. Burdened by unsustainable levels of debt and a weak economy, Greece was unable to refinance its debt and required a bailout from the European Union and the International Monetary Fund. Other countries, such as Ireland and Portugal, faced similar challenges, and the Eurozone as a whole was forced to implement austerity measures to restore stability. Key lessons: the importance of sovereign debt management. The Eurozone debt crisis reinforced the need for prudent fiscal management at the national level. Countries must ensure that they do not rely excessively on borrowing and that they maintain fiscal buffers in times of economic growth. The need for structural reforms. The crisis highlighted the importance of structural reforms to enhance economic growth and competitiveness. Countries that implemented structural reforms, such as labor market changes and pension system overhauls, were better positioned to recover from the crisis. The role of political will in crisis resolution. The Eurozone debt crisis also demonstrated the importance of political will in crisis management. Resolving the debt crisis required difficult decisions, such as austerity measures and reforms, which were politically unpopular but necessary for long-term stability. Learning from the past. Europe's history of financial crises offers valuable lessons that are relevant today. The Great Depression taught the importance of regulation and government intervention, while the Eurozone crisis highlighted the challenges of currency unions and exchange rate mechanisms. The 2008 financial crisis and the subsequent Eurozone debt crisis emphasized the risks of excessive debt, the need for strong banking regulation, and the importance of fiscal discipline. As Europe faces new economic challenges, including the uncertainties posed by the COVID-19 pandemic and the ongoing geopolitical tensions, the lessons from past crises remain relevant. By learning from history, Europe can build a more resilient financial system that is better equipped to withstand future shocks and safeguard the economic well-being of its citizens. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts, and I'll see you in the next one.